We're here today with the one and only Scott Taylor, our amazing CPA with Piercy, Bowler, Taylor, and Kern, and I've got all kinds of awesome questions for him. So thanks for coming by the office.
Great to be here.
Perfect. So unfortunately, this isn't as fun as looking at luxury real estate, but hopefully it keeps more money in our clients' pockets so they can buy that luxury real estate. So you just finished a busy season. You brought a book along with you.
Yeah, this is the explanation to the Tax Act of 2017,
Wow.
which was passed in late December.
That's how many pages is that?
This is just the explanation. It's a lot.
So you're over 1,000 pages.
Just explanation, yeah.
And how big, do you know any idea how big the actual act itself was?
There's 500 and some pages. Yeah. It was a lot of fun. Yeah. Haven't read the whole thing yet.
Yeah.
Read some of this, but some of this stuff doesn't relate to a lot of us. So.
Not quite as fun as Harry Potter, I'm sure. So we've got a lot to hit on today. The one that I wanted to jump right into, which is the one that shocked me the most, and I've been telling other people about it since we had that conversation, was the food and entertainment deduction. Tell me about that.
Completely wiped off. For 2018, any personal, business, entertainment expenses, non-deductible.
Except if they have it at their office.
At the office, plus including all employees. Mm-hmm. So one of the kickers for part of the law is if you invite just what's considered the highly compensated, so the high-end executives,
yeah,
and they're invited to it, non-deductible. Invite everyone, okay. Out to a facility, that's a different story. It's non-deductible. Got to be very, very careful.
And I know that this is new, so kind of the nuances have yet to be explored. But I think you were saying, or like if it's more of an educational seminar, type format offsite.
Yeah, that's where it will get a little bit more, controlled and planning effort to make sure that you have a real business and learning purpose at that facility. You can likely sort of bifurcate that law so that you can make it deductible.
Yeah.
But there's going to be a lot of discussion about it. Let's put it that way. It's going to be probably not case law for a couple of years, but a lot of notices from the IRS. That's how the IRS works.
Yeah, and I was at a lunch yesterday with clients, and I'm telling you, we talked real estate the whole time. I mean, it was, they sold here, they moved back east, talking about what they bought back east, and eventually they're planning to retire back here, and what they're going to be, they're going to start looking now because they're open to buying something and remodeling, and not remodeling now, buying it and renting it because they plan on remodeling once they retire, so they're in no rush. But the point being is, like, we talked a lot of business, that lunch. And
yeah, the old school is you have to remember to substantiate what your business purpose of that meeting was and what you discussed and so forth. That's out the window now. You technically still have to do that for your other activities, but for meals, entertainment, poof. Just got to be careful with how much money you spend on it nowadays.
Got it. All right. Yeah, so lots of questions, which goes down to, I'm sure, other gifts, bonuses, and talk to your CPA, talk to Scott if you got questions, and I'm sure we'll maybe update this further down the year as we learn more, because it's obviously a big part of our business with entertaining and guests and client lunches and dinners, and we'll have to figure out how to navigate that. Otherwise, we'll just be inviting everyone to the office for happy hour. So, another big one, the mortgage deduction.
Yeah, the mortgage deduction is going to be a little bit tricky because the physical law is $750,000 of debt.
Okay.
Is it?
And what did it used to be?
$1,000,001. That included $1 million of your regular debt and $100,000 of your home equity debt. They grandfathered all prior mortgages into place so that if you had a current mortgage before the act, you were still able to deduct that interest. But all new debt, $750 is the number.
Got it. So all new debt, it's $750 is the max, and that's not a combined thing. It's just a $750 mortgage of $750.
Yeah, and it causes a problem if you have multiple homes.
Oh.
So obviously, if you have a second home in, the coast, fairly expensive real estate, maybe you didn't pay full cash for it, that debt might not be deductible anymore. You got to talk to your accountant about that. There might be
course.
some ways to get around that,
Of
treating it
course.
as investment property, but technically, second home parts of that number.
I got it. I'm assuming if certain things are their own LLC and sort of their own entity is a property, but who knows? That's where I leave that to the pros. I'll help you buy it or sell it, but everything else you got to talk to this guy. So that's the mortgage deduction. So now we've got the state income tax deduction off the federal, however you explain that. I mean, we're in Nevada, so we have the benefit of no state income tax, but for all the big markets that kind of come here already to some degree to either retire or establish residency, this is going to even play a bigger role in that. And so, go for it.
The basic rules are this. We're a border state of California.
Yeah.
A lot of people have things across the border. Anything across the border requires California taxes. So a lot of Nevada residences pay a little bit of state income tax to California. The rule is real estate taxes and state income taxes is now limited to $10,000 on your Schedule A itemized deduction, which it's a combined number.
Real estate and
State income taxes. So that goes for whether you have state income taxes in California, Utah, Arizona.
So let's just take someone in California that makes, what do you say, $2 million? They have $2 million income for the year. And so as a federal, they're going to pay, in general, they would pay how much? Just easy math.
35 to 37%.
Got it. So that's going to be, let's just say $700K in taxes to the federal off of $2 million. This is just a scenario. I know there's a million of them. Yeah. And California, what is it? It's 10, 11%?
13.8%.
So off of 2 million, whatever, let's just say 220,000 to the state.
Close number, yep.
So was it before that you would take the whole 220 off the 700?
You still pay the federal income tax, but you have an itemized deduction, which creates, it's kind of like your mortgage interest, your charitable contributions. Your state income taxes was a separate deduction on your Schedule A. That 220 in that example would be part of your Schedule A.
Got it. So for the layman here, do you take the 220 off the 700?
No. The 200 becomes a deduction and reduces the 700.
Right. So the 700 is now 480 to the federal and the 220 to the state.
Yeah, close.
Ballpark. So now all of a sudden, this 220 is knocked down to 10.
Including your real estate taxes. So if you have a house where you pay $5,000, $8,000 of real estate taxes, now you got $2,000 left for that.
Oh, that's really nice. Yeah. So that really just goes away pretty much.
If you have two homes and that's over $10,000, you're not going to get anything for state taxes.
Got it. So for the people, for this $2 million income scenario, that basically means they're going to have to not only pay the 700, but they're still going to have to pay the 220 on top of that.
And they'll get no tax benefit on their federal return for that 220. That's the real kicker. No tax benefit for it. It's almost like you're paying a double taxation. You're paying federal income tax and you're paying state income tax, but you always received a benefit for state income tax in years past. Now you might not.
Ouch.
Yeah, that's very painful. So be careful when you cross the border and make money.
Yeah. So, which leads to another great discussion of how do you become a Nevada resident and put that 220 back in your pocket? Yeah. So, or more in many cases. So, what are the guidelines for becoming a Nevada resident?
Well, first off is when you see the tax rates of California, which are somewhere in the neighborhood of 13.8%, they go up from there. And they're fairly high marginal tax brackets. They make it so a lot of people are moving. They're moving to Nevada. Yeah. They're moving to less taxing states, Arizona, Utah, even Oregon. But very high income taxes makes you want to change your domicile. Yeah. And that's the key to residency is you've got to physically change your domicile. That's basically a legal way of saying change your roots, how you conduct your life, how you basically deal with your day-to-day affairs, your domicile.
Got it.
So that's the first key to changing your residence to the state of Nevada.
Mm-hmm.
Second in line is how long you are inside that state where you now domicile in. So if you're in that state more than 182 days, it's more than half the year, it sort of helps your mindset. There's a lot of people who live in multiple states.
Right.
They might live in Texas, Florida, Nevada, a little bit in California because they got a nice house there on the beach. You just got to be careful with your time because they're following up people big time.
Yeah, I heard that even they're using phone records now where it's like, because your phone knows where everyone's basically got a GPS on them now, and so they can tell where you are just from your GPS and what network your calls are coming from. So they don't even need to look at every one of your calls. It's just what network was. Oh, he was, you know.
That is for sure. There's pending franchise tax board examinations with. That's part of their discovery to see if you've really domiciled. It used to be, hey, make sure you're careful with what you spend when you're across the border. Make sure when you're in Nevada or outside of California, you take care of your spending so that it can be documented on an electronic bank statement or a credit card statement. Now you've got the additional issue of, hey, now we want your phone records. They can see where your texts originate from. They can see where your phones originate, where the calls are coming to and from. And so it's kind of putting an additional mechanism to your phone records. Some people have multiple phones now.
The throwaway, the burner phone.
They just change their phone all the time so they can get around that issue. So.
Right, now you've got all these different, like, you can, I guess, use a phone that goes off of VoIP to talk with people on, Facebook Messenger or other. I'm sure there's tricks, but at the end of the day, like that might buy you 10, 20 days, but the reality is like you better be spending a lot of time in Nevada, if you're trying to have residency here. And, what do they say? You got to have your driver's license here, utility bills, bills mailed here. Like, it's something to be taken serious. I mean, it's a serious amount of savings, and there's a good reason to do it if you can, but don't just think it's.
Yeah, there's a couple good things to get in the habit of doing. First off, you want to attend church when you're in your place.
Okay.
So you can show that, hey, I'm domiciled in that state. You want to have sort of professional relationships in that state. That could be your attorney. That could be a real estate person who helps you with finding other properties. You want to have your physical business activities inside the state as much as possible. Helps to have a CPA in the state too.
Exactly.
But your bank's good to have in the state. It's good to have your financial advisor in the state. But there's one little trick that happened. People used to think that you could not go get doctor care inside California, otherwise you'd be tagged a resident. We can thank Mayor Jones. Remember our old mayor?
Okay.
Old mayor. She was inside the state of California for health reasons. She had extensive cancer years ago, and they tried to make her a resident of California. Well, they lost in court. So that helps us.
Okay.
It used to be you used to have a physician in the state. Not necessarily the case now. This still helps. Part of your domicile.
But it makes sense. I mean, that's a fair play. It's like when you have sophisticated needs from a health perspective to have to go out of state to get them. Well, obviously a lot of details there, but if you're in one of these other states such as California and taxes just went up substantially and you're considering changing your domicile, then give me a call, give Scott a call, and we'll help you.
Nevada's a friendly state when it comes to taxes, especially individual taxes.
Oh, well, I know you say that, but it sure doesn't feel like that sometimes. But I guess if I was coming from California, at least I have some flesh left.
I say it's fair because it's zero, except for car registrations.
Yeah, Teslas aren't cheap on the car registration. So that's the big meaty stuff we had today. Some other just small items which are still important. The Foreign Investment Real Property Tax Act, also known as FIRPTA. What's that, Scott?
Boy, that is a changing law, changes often. The rules change, the deadlines change often. You need to be very well connected with your professional advisor on what needs to happen with that. Be very careful with the real estate transactions that you have. A lot of times you have people who are wanting to become residents. They don't have a Social Security card. They don't have an I-10, and then they go to sell their property. Now they have to deal with the title company and what the rules are. So it's better to be into the game, ready for what's coming before it becomes too late when you're getting ready to close on a property.
Right, so it comes up not so much with buying, but when it comes time to sell, generally what happens was, at least the last time I had to deal with this, the title company is forced by the IRS to withhold 10% of the gross sale price, not just the proceeds, but the actual sales price. So even if there's not enough equity there, that's its own whole problem or discussion, until the person can file a return, basically. So the big point there is, if you own property in Nevada and you're not a resident, not a resident of the United States.
Yeah, if you're not a citizen,
You're not a citizen, yeah.
you're not a taxpayer,
Yeah.
you may have the other problems.
Then you might want to, even if you don't plan on selling it for a year or 5, maybe worth having the conversation with the CPA now to sort of sort that out and maybe get that structure in place, so when, if you might need to sell sooner than later, you're not going to put yourself in sort of a bind.
Yeah, I think the key is if you're inside the United States for a period of time and you have earnings inside the United States because you're a non-resident alien, you want to become a tax filer. Even though it might be small tax burden, you want to file a tax return so you can register and get an international tax identification number that's on your forms.
Got it. And another thing to throw out there is, someone might think, well, I'm not making any profit off this property. I might even be selling a property at a loss. But guess what? The IRS doesn't know that until you file a return. So they're going to force the title company to skim that money off the top and hold on to it, which means if you're already losing money and they're taking the money off the top, you might, I don't even know what sort of predicament that, you might have to then bring money to close to make up the difference. Like, it could really be a predicament. Fortunately, I haven't.
Yeah, I think the real hang-up with FIRPTA and foreign sales of real estate and that 10% gross receipts, they may be a break-even on the physical sale because they paid almost as much as their closing costs and so forth. But when the title company is mandated to withhold on that, they have to send it to the Internal Revenue Service with an attachment to an ID number. And that's where the problem really comes.
Right.
Is the title company, if they don't have an ID number, they're held up. They have restrictions from the IRS also, and it becomes a problem for both parties. You have this floating withholding.
Got it.
Somewhere, the title company will send it to the IRS, I will send it back, and you can't register. So the person that wants to file a U.S. tax return, they want to claim that credit.
Yeah.
They can't claim it because it doesn't attach to something.
So
an
yeah,
ID.
one more reason to.
It's a big deal.
That's a mess. So yeah, if you are not a U.S. citizen, just start filing some taxes here. Well, specifically if you own property here.
Yeah, get your I-10 registered and file some taxes if you're a part of your resident.
Oh, that's bananas. So short sales, they still exist. They're not as prevalent as they once were, but they're still out there. And one of the things that is an issue that a lot of people weren't aware of until it comes up is the idea of debt forgiveness. So for example, if someone borrowed $1 million to buy a home for $1.2 million, and today they're selling the home for $800,000 as a short sale, meaning they're not going to come out of pocket the balance, but they're going to short the bank. So the bank is already going to get the less from the $1 million they're owed to the $800,000 it's selling for, but it's going to be even lower because there's real estate fees and closing costs, and perhaps there's penalties and whatnot of the seller not making payments. So let's just say, they're down to $700,000. So the bank's getting shorted $300,000. Well, the idea is that $300,000 of debt forgiveness by the bank could be counted as income. So then this is where it's, the question then is, every year we're always wondering if they're going to renew or sort of waive that. How do you explain it? Waive the debt forgiveness?
Yeah, it's the debt forgiveness law which was being extended. The tax law is merely an extension of that forgiveness provision.
Got it. So basically in that scenario, that $300,000 of debt that was forgiven could be counted as income that you'd have to pay taxes on. However, I believe you just mentioned that for 2017, that was extended. It's been extended through 2018 as well. So if you
the tax law that was passed in late December of 2017 did not include the extension bills.
Okay.
Therefore, in February, they issued the extension bills, and that was part of those extension bills, the debt forgiveness.
Yeah.
If it's a primary residence.
Got it. So hang on to that thought for a second, which it always cracks me up with this. Like they dealt with 2017 into 2018, so people didn't really know.
Yeah.
But it sounds like they did state for 2018 in February that the debt forgiveness is still in effect. So, hey, if you're out there and you do have a short sale that you need to do for a primary, that you're still in good standing to be able to get that debt off your books and not actually have to pay additional income tax. What happens if it's not a primary?
Then it's taxable.
Okay.
If it's taxable if
Okay.
you're not insolvent.
Ah.
So then you get to the very difficult tax law under Section 108 of the Internal Revenue Code, which is the insolvency rules.
Yeah.
So then they take a picture of your life before the discharge, net worth,
Yeah.
versus your net worth after the discharge.
Okay.
And then you might get some relief from the insolvency rules.
Got it. One more reason to chat with the CPA.
Lots of fun there.
Yeah, I'd be curious to see how many of those are still floating around. I mean, obviously with prices that have come up substantially, and I think there's probably not nearly as much as there once was, but I'm sure there's. I think any of my venture would be to guess that the majority of short sales are left are primaries. I think most of the investment stuff were the first to go, just because once the property was so underwater, then usually that also meant that it was negative cash flow. And so that was what sort of started the snowball down the hill back in 2008, 2009.
Yeah, I think a lot of the Las Vegas and the Southwest area has now sort of picked back up. So there's not so many upside down people.
Yep.
However, if they took out debt on that primary residence to go into other properties, that's where it gets a little bit tricky in the debt discharge, because that debt was not related to that primary residence.
So if you had a primary where you took money out to then go buy this investment property, and now you're shorting the primary,
you might have problems.
all right. Well,
They get you on the way in or the way out to either way.
sorry for all the bad news today, guys and gals. But do you have anything else you want to add? I mean, I know you've got a lot there, but in terms particularly to real estate that might be worth chatting about?
I think the biggest part of the Tax Act, which is still in discussion mode, is this so-called 20% deduction
Okay.
for pass-through or business activities. It qualifies for Schedule C's, Schedule E rentals, your businesses and so forth.
Right.
The key is this, is if you're a professional under the definition of what is a professional, the 20% deduction doesn't qualify to you. Accountants, doctors,
Yeah.
lawyers, engineers, doesn't count. They're specifically listed in the law. However, there's a lot of discussion right now as what professionals might be also included in that number. So real estate agents, are technically not part of that professional mode, but stay tuned, because they might try to bring in this definition of professional. If you're under $450,000 of income, you very well might get a 20% deduction on your real estate activities. Because technically, if you're a successful real estate agent and it's your brain doing the work, and you're developing the goodwill and you're developing the professional relationships and so forth, what's different about that and some other consultant that has employees? Not much.
So thanks again, boss, for coming in today.
Great to be
It's been
here.
a pleasure. And how can folks reach you if they have questions or
Yeah.
anything?
Email address is staylor@pbtk.com, and Piercy, Bowler, Taylor & Kern is the location, 702-384-1120. Thanks.
Perfect. Thank you.